Hey everyone, this is Mikey Roux, founder of Dividend Stocks Rocks and passionate investor. Welcome everybody. I have to warn you, this is a huge webinar. Presentation is likely to be like between 50 minutes to an hour. So I'm gonna make it quick for the introduction. A lot of people are logging in right now, so it's normal that the image is blurry and the sound is shaky a little bit. Give it like 30 seconds, a minute, and it's all going to be fine. You can always say hi on your comment section on your right. It's always fun to see who's coming in and everybody. And the webinar will be recorded, so you are going to receive a full replay later on tonight or tomorrow morning, the time that it's being processed. There will be a Q&A session at the end of the webinar, so you can also ask all your questions, not in the comment, but rather way down below in the question section right under your screen. There's a question section there. You can put all your questions, and at the end of the webinar, I'll move forward with that and try to answer everything as much as I can. All right, so just waiting for Véronique. Are you there? Vero is my core business manager. She's usually around for in the comment section if you have any questions or any trouble or something. So I'm just going to make sure that she's coming in. And here we go. We're going to start. All right, so while you're here, today I am sharing my buying process from A to Z. This is the reason why it's a longer webinar than usual. My goal here is not to tell you how to invest, but rather help you to invest with conviction. Get rid of that paralysis by analysis. We are overloaded by information all the time, and the key here is to be able to build a strong strategy that you can follow all the time, and you avoid to doubt yourself, you avoid to wonder what you should buy, when you should buy it, and so on. So this is why I'm doing this webinar today. You're here, as I mentioned earlier, you're here to ask your questions. So there will be a Q&A session. I'm going to answer everything as best as I could. There's no buy or sell recommendation. I am not your personal advisor. I'm not your broker. So therefore, you cannot take what I say today. We're going to discuss stock picks, and you can ask my opinion on everything, but you have to do your own due diligence. I am not responsible for your losses or your profit. Same thing for DSR, which is, hey, Véronique, so I'm glad that you're here. I was starting to panic a little bit. So yeah, and at the end of this webinar, I will invite you to join Dividend Stocks Rocks, the DSR community. Yesterday, we had a similar webinar. We have over 1,500 members at DSR. Yesterday, we were more than like 150, I think, live. You wouldn't believe all the questions that we have, all the resources. Everybody's helping each other. It's a great crowd. So I'm going to invite you to join us. Now, let's go. Have you ever wondered why the biggest goal in your life are like the solutions to achieve them are simple yet incredibly difficult? When you want to lose weight, all you have to do basically is eat better and train more, right? If you want to do like myself in 2016, I quit my job and I traveled the world with my family. So all I had to do was quitting my job, buy an RV, and drive from Montreal all the way down to Costa Rica and Dominical. If you want to live happily married forever, all you need to do is communication and listening, right? You have to do that with your spouse, and that's pretty much it. And why is it so difficult to achieve those goals while the solution is like right in front of our nose and it's super simple? The problem is the process. It requires consistency, conviction, and action. And if you don't have 3 pillars, you're not gonna make it. You know, I keep battling myself to try to lose weight all the time. I run, but when the weekend happens and there's ribs on the barbecue, I can't help myself to have a second portion. You know, this is what is so hard, to be consistent and to have that conviction to take those actions. So today I'm sharing my process with you for that reason. I've come to realize that it's, at first when I worked on that webinar, I thought, you know what, I'm going to present it with like investing is half science, so half maths and financial metrics, and the other half is art. understanding what's going to happen, making assumptions, making the right calls. But actually, there's a third component, and that component is magic. And not magic in the sense that you have to get lucky and then you have to ride the right timing or stuff like that. No. What I mean is, if you master the science behind investing and you master the art of understanding business models and making the right assumptions, your portfolio will create magic. The long-term investing strategy works. You know, even if we had a small crash in 2018 and a big one in this year in March of 2020, my portfolio never showed negative value compared to what I bought. I was losing profit like anybody else, but the magic was I had some holdings there like Apple that almost reached 500%. I bought it before they split back in 2014, and that kind of magic is created only if you hold onto your winners. A lot of people say you're making money when you buy and not when you sell, right? And that totally makes sense. If you don't buy the right assets, if you don't buy it at the right valuation, a lot of people will tell you about valuation as well, you're not going to make money in the end. And this is why it's so important to be consistent, to invest with conviction, and most importantly, take action. So some of you know me, some of you don't. What makes my process different is not as much as my process itself, but because I found a way to make something very clear, very straightforward and simple, like easy to use. I started investing in 2003. I started at the same time I was starting my career in the financial industry. I remain 100% invested in equities since then. At first, however, I was trading on margin. I was buying and selling stocks every 2-3 weeks. Made a lot of money out of it. I actually got my name on the journal in the Globe and Mail because I bought my first house with only profits from my trades between 2003 and 2006. Those were the good days, right? You could pretty much like throw a dart on the board and just make money for whatever stocks that you would choose. And later down the road, I realized that I hit a wall. I lost money on some transaction, and then I realized I need a stronger process. I cannot just trade on my gut feelings and some financial background. You know, my MBA in financial services and being a certified financial planner and then a private banking was not enough to bring me this level of comfort when I was looking at my portfolio. And this is when I decided to shift my investing strategy towards dividend growth. I only buy dividend growers besides Amazon, which is a different play, and you can ask me a question about it later on. But the key here is I realized that dividend growers are outperforming the market and doing it with less volatility. So in general, it means making more money and with less stress. So that sounds a pretty good deal, right? So I shifted my strategy in 2010, focused on dividend growth stocks. And today I only use my own tools. So all the tools that I've designed at DSR, today I'll show you how to use those tools, but you can as well do most of it from like free resources and going right and center. But just to make yourself at ease, you don't need DSR to invest. You can do it with other tools as well. So the first thing I do when I want to look for another company, I use a stock screener, and then I will use what I call the Dividend Triangle. So I'm going to put it a little bit bigger. I'm going to talk about two companies mostly during my my presentation today. We're talking about Visa and we're talking about Fortis. Kind of funny because two companies are completely different, but they both show incredible dividend triangle. So what is it? We're talking about a company with growing revenue, earnings that is growing, and then dividend growth. So what you see here is a company that is quite impressive, Visa. I mean, 200% over the past 10 years in terms of revenue growth, 500% for earnings, and 860% for dividend. Now you're going to tell me, well, Mike, I don't care about Visa, yields at 0.6%, and this doesn't mean anything to me because I'm retired or I'm about to retire and I need income. Well, the thing about that is dividend isn't magic. A dollar paid is not a dollar that is being created out of thin air. When you think about it, if you look at Microsoft, for example, that has over 100 billions in cash, if tomorrow morning they decide to pay a special dividend of 75 billions, what's going to happen is that their shares are going to drop just as much because they're taking that money out of the business. So it's out of the business, in your pocket. You feel good about receiving money, but in the end, you haven't created anything. So basically, a company paying you a 5 or 6% yield is basically reducing its value every single year by 5 or 6%. Then you have a lot of other factors that will come into play for the price, so you don't always feel it that way. But keep in mind that especially in times of uncertainties right now, you're better off focusing on dividend growth. So what I do is I look at companies that are leaders in their market, that have growth perspective, that has competitive advantage. Those will obviously push revenue up. And technically, if your revenues are going up, your earnings should go up as well. And eventually, dividend will follow. Now, a lot of ETF investors, and I'm calling for Ben Felix here because this guy has a huge YouTube channel, interesting following, over 100,000 people are following him on YouTube. And he's well known for his, I would say, I don't know, he's well known for saying that dividend doesn't matter and it's not important and you should not invest in dividend, right? He's a CFA, portfolio manager, so the guy knows what he's doing. And he's coming with a lot of research and stuff like that. But the point that he's making is dividend growers tend to outperform the market. If you look at any kind of studies from Vanguard, actually, or Ned Davis, or even Ned Faber from Cambria, they all provide proof that dividend growers are beating the market with less volatility. But then they kind of like had a twist, are saying, yeah, well, that's because they are exposed to certain factors, such as a solid balance sheet, robust financial metrics. They come with like this perfect package where the business model is growing and it's doing well and margins are good and cash flow are coming in. And this is why they are outperforming the market, not because they pay a dividend. And that I agree with them. What makes the difference is when you select dividend growers, you're picking stocks from the best basket ever. So yes, you're not going to find the next Facebook in it, but if you're able to consistently invest and find the right companies all the time, and those companies grow over years after years with their dividend and everything, you get rewarded. And this is where the magic comes from. It's not coming from the dividend, but a management that increases its dividend every year is committed, is confident about its business model and its ability to be able to pay down the road. And that's why it makes such a difference when you start investing. So once I have filtered the stocks with the dividend triangle, and what I do when I look at the dividend triangle is I'm looking at 5-year trends, positive trends for the 3 factors. So sometimes it starts with a revenue growth of 2%, which is not much, and then I start digging. But this helps me to narrow down my list to a very simple bucket where I can pick stocks from it. The second step I do is I look at my sector allocation, because sector allocation is key. And from time to time, what you're going to find here is you pull out all your filters, regardless if you're using my filters or some others. You're putting those filters into play and you're looking for companies, and depending on when you do it, you have a specific sector that will come up on the top. And especially right now, if you apply the dividend triangle, the best companies that you will find are technology stocks, obviously. Old tech stocks like Microsoft, Apple, Texas Instruments, OpenText, Sylogist, Nhouse. Those companies are making a lot of cash flow. They're built for pandemics. They didn't know that, but they were built for that. And obviously, if you pull out a stock filter, you're going to find like the top 10 stocks will all be tech stocks. The problem is you cannot buy them all. If you buy them all and you then become overexposed to a specific sector, then you increase your volatility, and eventually one day or another, remember the tech stock, remember the financial crisis, this sector is going to get hit, and then you're going to lose money. So what you can see here on my asset allocation, that's my personal portfolio. That's my pension plan that I report every single month. Basically what I do is back in 2017, after I came back from a 1-year travel with my family, I decided to quit my job and focus solely on dividend stocks rock. DSR was created in 2013, but in 2017, it started to boom because I worked on it all the time. And this portfolio is coming from my former employer, National Bank. They sent me a nice fat check of $108,000, which was my pension plan, and I decided to invest it all in 2017. So if you're curious, you can go on my blog and look at the all my information for how I manage my portfolio. Point here is I'm overexposed to consumer cyclical, financial services, and tech stocks. So this is like roughly 70 to 80% of my portfolio. Ideally, I would not go over 20% in a specific sector unless I have the ability to use subsectors and to make a little bit difference here. So for example, in the financial services, I do have Canadian banks, I have assets managers, and I also have Visa. So Visa is half a tech stock, half financial. Then you have Canadian banks like Royal Bank and National Bank. And I have asset manager, which are Lazard and BlackRock on the US market. So I have like 3 subsectors. They will not react the same way for each in terms of events or stuff like that. So this is why it's still good. But then again, if I pull out my filters and I look and I found that Broadcom, for example, which is a very good tech stock that I really like, that's been recommended. It has been shown as a buy at DSR, but I cannot buy it. I cannot buy it because I have Apple, I have OpenText, I have Sylogist, I have Texas Instruments. It's too much tech in my portfolio. I have to get rid of it. So sometimes you have to let a good opportunity go, but you have to focus on your sector allocation. This is a lot more important. So now we have filter the market and pick a few stocks depending on the sector that I'm looking for. Good, very important point in terms of sectors. As you saw, I am concentrated on growth sectors a little bit more because I am younger and have more years in front of me to manage my portfolio and grow it. If you are retired or about to retire and you look for income, then you should have overexposure of like 20% per sector in utilities. You can go with Reits, and we're going to discuss Reits in a few slides. Go with healthcare, telecoms. Those are more stable businesses that will pay a higher dividend. Canadian banks is always a good solution, even if you're American. They pay right now like a good 5% yield, which is quite impressive, and they're working in an oligopoly, so they're like quite safe investment and often forgotten because of that. So just to say that depending on what is your goal, if your goal is to add more growth, then on top of tech stocks and consumer cyclical, you can also look for industrials. Industrials in a sense that when we enter in a recession, they tend to go down very fast because they're highly cyclical. So this is your time to pick up some great industrials. 3M, for example, that's a classic one that has been beaten down since 2018, hasn't recovered yet. So here's your opportunity to get some more growth in your portfolio this way. So once you have your stocks and then you have selected them per sector, what you need to focus is dividend safety. Why? Not because of the dollar that is paid, but because if the dividend is safe and keeps increasing during the recession, first thing is the market is down and you're getting paid to wait. So that's good for your ego. That's good for your mental. So you look at your portfolio and you feel a little bit better, because when you start to doubt, oh, this stock's lost 20%, I'm freaking out. You go back into financials and then you just read comments from the CEO saying, oh, we have increased our dividend by 5% this year. And then you're just like, okay, so if management is confident they're able to not only distribute some of their cash flow, but actually pay me more, well, I don't really care about what's going on in the market. It's going to come back up because they're confident the business will do well. So I'm a big believer that offense is the best defense. Having a strong dividend triangle will actually ensure you to cover pretty much all metrics. I know a lot of people like to look at cash flow metrics and debts and stuff like that, but actually, if you have a company that is growing and making more money and increasing their dividend, chances are they're generating more cash flow, and chances are that they have debt under control. So once you have focused on that, a lot of people will say, okay, Mike, now I'm going to look at the payout ratio and the cash payout ratio. So I'm going to share my screen and show you something quite interesting. So imagine that you have selected Fortis. The reason why I selected Fortis as an example here is I wanted to have a fast growth, which is Visa, and I also wanted to have a classic dividend growth stocks, which is Fortis. Fortis yield, we're on Dividend Stocks Rocks, obviously. Those are web pages. If you go right here, you see dividend yields at 3.62. If you want a shortcut, you have the pro rating and dividend safety score. Those are based from 1 to 5. So obviously members, they don't have to go through the entire buy process I'm talking about today. They can look at, say, oh, this one is a buy. The dividend safety score is at 4%. That totally makes sense. It fits with my asset allocation. I like the yield. Boom, I'm buying it. So what we like about Fortis is, as I mentioned, good dividend triangle as well. So you see very steady. We have like 46 consecutive years of increase. Earnings will always be a little bit choppy. This is where when you look right there, somewhere in 2017, there's probably a good reason why you want to investigate, and those trends will tell you what to look at, which is very interesting. And you can see that revenues are growing also. So you have here 5-year revenue 10%, 22% for the earnings, and then dividend growth at 7%. So very healthy dividend triangle right here. So now let's go to the dividend perspective right there. Sorry, I'm having a problem with my mouse. So dividend perspective, we have a payout ratio at 38, so we like that. Payout ratio behind 80%, below 80%. Very nice. There's room for increase and everything. So at 38, it's amazing. But what bugs me is a negative cash payout ratio. That doesn't make sense, right? The company is not making enough cash to pay the dividend, yet they expect to increase their dividend by 6% annually until 2022. How is this possible? On top of that, we are actually rating it as a dividend safety score of 4, so very safe dividend. So when you go back here, and this is what we discover when we do our analysis at DSR, if you don't do it, what you have to do when you see those kind of things, a high payout ratio and our high cash payout ratio, it is not a no-no. It's an investigation to, it's an invitation to investigate, actually. So what you're going to find is they had capex of $14.5 billion between 2018 and 2022. This means that they plan to invest 15 billion in 4 years. So this is kind of like crushing your cash flow, right? So in reality, what happened when you look at the cash payout ratio is the net cash flow and then minus the capital expenditure. So investment like this will count as capex. So if you withdraw that 15 billion out of cash flow, obviously they don't have enough money to pay dividend. But in reality, what they will do is that they will either borrow more debts, or they will issue some shares or units if there were Reits to finance their project, and they will use their cash flow to pay out dividends. So it's important to have a global vision over here. And when you look at that, and then you look at what's happening with Fortis and its 15 billion spending plan, then you're thinking, oh, I need to look at the debt trend. What I'm looking here is more to see what's happening with the debt over time, more as a trend than a total amount, because the total amount can vary depending on the industry, depending if it's capital intensive or not, but it will tell you at one point the company must pay it off. Right now, debt is cheap. It's basically free money, so it's great for a company like Fortis to invest massively. A lot of utilities do that right now, so you're going to find a lot of high cash payout ratio or negative cash payout ratio right now. It doesn't mean that they cannot afford it. It's actually, to the contrary, they're building cash flow for the future. So one thing I like to look at here is the cash flow from operation the free cash flow versus the debt and see which one is going up and which one is going down. A good example is I've been known to not like AT&T too much for several years because I didn't like the fact that they were just racking up debts like crazy without generating much more cash flow or earnings. And at one point, and they had like a lot of projects on the table, buying Time Warner, including DirecTV, paying their incredible dividend, developing 5G. So all of this requires a lot of debt and liquidity. And I found, it's not working well. And then in 2019, in the summer of 2019, debt is starting to go down. They finally crossed that threshold and increased their cash flow generation, and now they're able to pay off their debts on top of maintaining a very generous dividend. So there you go, dividend safety is increasing, it feels good. So then you have something that is a little bit stronger, and most companies that are able to maintain and increase their dividend during crisis like this one, they will survive, and then they will thrive down the road. They will be a lot better and a lot stronger. So now let's take a pause of the stock market and talk about REITs a little bit. The problem is the dividend triangle will not work very well with REITs because revenue are there, but earnings are not there because earnings are meaningless for REIts. What you're really looking at is funds from operation and adjusted fund from operation, and I'm sure you know that. But here the thing is, REITs are built to pay you up. So as a retiree, as someone who's looking for income, that's a perfect vehicle. You're going to get the most of their profit into your pocket every single month or every single quarter. So it's great. However, don't fall for the yield. Yield is not everything, especially right now. Well, think about it for a second. Interest rates are incredibly low right now, but they have been low for 10 years. So debt is cheap. Unemployment rate was super low before 2020. The economy was rolling before 2020 as well. Consumer confidence was great. So for that past 5 years, past 10 years, if the REITs was not able to increase their dividend, there's a problem. And now we've seen a lot of REITs cutting down their dividend because what they do is that they've been going from a growth strategy to a gluttony strategy. What does that mean is that they were so focused on buying more properties, buying more assets, and growing their revenue. They were issuing units like there's no tomorrow, and they were also racking up debts like there's no tomorrow. And keep in mind that when the REIT is issuing units, they must pay the same dividend yield to everybody. So if they issue another 1,000 units every day, well, then there you go. They have to pay 1,000 shareholders more of dividend. And this is what makes it so heavy for them. So what I look at is not the FFO or AFFO, but FFO per unit. And if this doesn't grow, if it hasn't grown in the past 5 years, right now they hit a recession, and at DSR, all dividend safety score were at 2 for REITs that didn't increase their dividend over the past 3, 4, 5 years. Most of them had a sell rating, even though they were doing well, because everybody looks good on prom night. The next morning is something different. And this is what's happening right here. Now they're stuck with a recession, they're loaded up in debts, and they have to cut their dividend. On top of that, a lot of subsectors in the REITs, we're talking obviously about offices and malls and shopping centers. Most of them, they are running into a very bad situation. We have all the updates right now coming up on the rent collection for April and May. Some of them are at like 40% or 30%, and some others are able to collect like 90 or 95%, depending on their subsectors. So you have to be very careful on where you put your money when you invest into REITs. Those that are doing very well right now are obviously cell towers, data centers. We just reviewed Equix this week. Actually, tomorrow on Friday, members will receive the stock cards that they announced on Equix. Very great company. You're going to have warehouses, distribution centers, industrial. We're doing well. Apartment REITs could do well as well. There's a good play to be made on healthcare REITs, but you have to be a little bit more careful with that. There's a little bit more risk revolving around that, obviously. But just to make sure that you understand that yield is not everything, and then you have to dig a little bit bit deeper. And you can, as a retiree, you can definitely have 30-35% of your portfolio in REITs as long as you hit different subsectors. Because obviously data center, shopping malls, and warehouse or industrial REITs will not react the same way right now. So now imagine that you have selected a few more businesses, a few more companies, and you look into that. And this is that was the science part. You know, you use the metrics, you use our data, you read graphs, so it's quite easy, quite rational. But then you go into the soft part, the art part. First thing is you must understand the business model. If you don't understand how a company makes money and how it will thrive in the future, or you're not too sure and you're telling me, oh, I like the yield or I like the metrics, but I really don't get what this company does, then you have a problem. You must be able to explain business model to a 12 years old. It has to be super simple. So let's take Visa, for example. Visa is the largest network for payment transfer. So you want to send money to someone, or you want to receive some money from someone, from a business or a government. They want to exchange money together. They go with Visa because Visa is the largest network for payment transfer. It is based on trust and security, and this is why a lot of people are using Visa. By being everywhere, they're able to scale. They make a lot more money because everybody's using Visa. And the last thing is the company benefits from a strong trend where cash money goes to digital money. So you don't walk around with your wallet full of 20s or $100 anymore. You walk around with a few cards, and one of them is a Visa. So here's my business model. So now I'm getting very excited about Visa. I've looked at the Dividend Triangle, I've looked at that sector and everything, and now I understand fully how the company can make money. And then I'm getting very excited, and this is the time that you have to put the hype down. This is the time that you must go see the potential downsides. My favorite technique for that is I'm looking for bearish thesis from others. So I'll look on Seeking Alpha, on different blogs, different analysts as well. But I'm looking for people that hate Visa very much, and I want them to tell me the different side, the other side of the coin. I want to see the different angle, and then I'll be able to understand the risk. So here we go. Let's take a look at what's happening with Visa right now and the potential downside. As you can see, you can always cheat and use DSR, and you get always the other side of the coin. Right here, potential risk. So basically, I'll let you read, but in general, what happened is the first thing is Visa annoys a lot of merchants. You know those point cards, reward cards that are like making you rich and making you pay some stuff? Well, merchant has to pay a very high fee for those, and they don't like it. So they will be open to try out new technologies. Visa is a fintech, so if there's another fintech coming up and say, hey, you know what, we have a better way to transfer money, or do you want to go with Bitcoins or any other thing? Well, obviously, Visa will be hurt from that. They will lose some negotiating powers at one point in time. So they have always to invest and make sure that they keep on track, and they're not getting beaten by another fintech or Bitcoins or any other technology arising. Second downside is obviously Visa is making a lot of money as the economy grows because they're making money on transaction volume. So in times of recession right now, economic lockdown, well, obviously it will be a setback. It will be a little bit harder for them to grow during that time. So as you can see, there's nothing very bad about Visa. If we look at Fortis, what's going to happen is potential downside for Fortis. First one is they're racking up a lot of debts. One day or another, they will have to pay. Right now, interest rate is super low. It may not always be the case. Second thing is, due to the economic lockdown, energy consumption is going down. So obviously in commerce and industrial sectors and segments, this is going down. So it's not helping Fortis to generate revenue this year. It's going to be very hard. And because all of this, and because Fortis is almost 100% regulated utilities, so this means that they have guaranteed rates and they have a near monopoly on specific sectors. specific geographic areas, but they need to deal with regulators. So state regulators are going to tell Fortis, oh, you can increase your rate by this much or that much, depending on how much you invest and what's the economy look like. So if Fortis is racking up 15 billions in new projects, thinking they're going to generate, I don't know, like let's say 12% return on that because they're going to rack up the rate through the roof. And then the regulator says, no, it's going to be 6%. Well, then they have a problem, and then it's going to be a little bit hard for them, and it will probably hit the dividend growth policy. It's not going to stop it, but it's going to be another slowdown. So here are the potential downside. You must be able to understand what's going on here, because if you don't, you're going to get caught by surprise. You're going to wonder what's happening, why stocks are going down all of a sudden. At the beginning of the pandemic, in February, beginning of March, utility sector was not too much impacted, right? They were pretty much staying their course, looking at other values like shopping malls and stuff like that going down, but they were just like, we're good. We're utilities. We're super stable and we'll pay a good dividend. People won't let us down. But the thing is then once states and provinces in Canada, they started to lock down and everybody goes on quarantines and then everybody don't work, power demand goes down. And the market realized, oh my God, it's not like a 2-5 days thing. It's a couple of weeks, maybe a couple of months thing. And it's going to drop the revenue by like 15% or 10% or 20%. And then you start to worry, and utility sector just went down the road and everything dropped at that point. But if you understand why you invested in Fortis in the first place, you also understand why it's going down temporarily, and you're just like, yeah, well, that's a temporary thing. It's not a new environment. People are going to go back to work, and then demand for power is going to increase again, and it's just a matter of getting the economy rolling. Now, potential upside. Now that you're a little bit more down to earth, well, potential upside, it's important to understand where the company is growing and then what are their growth vectors. If you have not growth vectors and you're just a good old stable company, one of my favorite examples is Altria, MO. Altria, like in 2016, I was saying that you should sell. I didn't like the stock at all because there's no growth vector. They're generating tons of cash flow, but they're killing their customers, and less people are going to start smoking, not more. So this is not a good thing for them, and they cannot find ways to outpace their dying customers with other products, and this is why it's been so hard for them. And now the stock is going down since their peak, and I don't see how it's going to come back one day. So I've discussed a lot about my process, and I haven't discussed the price yet. At DSR and in all my writings, if you follow me, I'm going to always tell you valuation doesn't matter. I'm making such a strong and bold statement because I wanted to go through the noise, and I want to make sure that you get it. The thing is, we don't know what's a good value today. We don't know if it's a fair value or not. Favorite example is, let's take Microsoft. Microsoft is overvalued today. Nobody's going to say anything against me. Nobody's going to disagree with me, right? But the thing is, Microsoft was also overvalued at $75 in 2017. But then nobody knew that it would double in price. So back then in 2017, I decided to invest money in Microsoft. And because I did my research, and I understand how the business was going, and I understand the potential upside and downside, and the metrics were always talking to me as well. And I see the potential in the cloud. I saw also what I like is they didn't have a strong dividend triangle back then. Earnings and revenues were kind of like not growing too much back in 2017. Why? Because they were moving at that point their business model towards subscription. So instead of buying another Windows 25 or Office 36, well, now you buy a subscription. So it's recurring revenue. But the shift from buying the new version to a subscription model takes time, and then it hurts revenue, because instead of making a shitload of money with your new Windows software license, you're making a little bit of money all the time, and make sure it's always updated. But over the long run, everybody pays their Windows or Office or Dynamics 365. Everybody's happy, and then they're just making a lot more money. So I saw that. Fast forward today, the stock doubled, but everybody back in 2017 were saying, the real price for Microsoft is $50. 55 at best. That's the worst case scenario. You should never put your money on it at 75 bucks. Well, you know what? Unless Microsoft splits its share, you're never going to buy it at 50 bucks again. That becomes obvious. So we don't know what's happening. What I like to do instead is to give the valuation analysis more like of a guideline for me to say if I should buy it right away or if I should wait a little bit. So the first thing I will look at is the 10-year P/E ratio. The reason why I do that is I want to have an idea of how much the market is willing to pay for that stock across the past 10 years, and then trying to identify why the P/E ratio went up or went down. Good example for that would be Target. Target started to surge like there's no tomorrow for 2 years in a row in 2018, 2019, if I remember correctly. But when you look at what's happening, it was just PE expansion, meaning that the market suddenly was willing to pay more for Target for its profit, for the same profit. So it's not because the company was booming, but they thought, oh, maybe it's going to boom. So I'm willing to pay a higher multiplier. And this is why you have P extension. What you would like in the best world is to see earnings growing as fast as the price. So then you always pay similar, like pretty much the same price. The second tool I like to use is the dividend discount model. Obviously, dividend discount model has lots of limitation as any others. First one is it will give you the intrinsic value, the fair value of the stock, but only considering the dividend growth potential. So when you look at a company like Visa, for example, it's a little bit hard for Visa with a super low yield, even though they have a strong dividend growth, to show undervalued. If you look right here in the valuation tables, even with a spectacular 18% dividend growth rate for the next 10 years and then going down to 7, I get fair valuation intrinsic value at 160%, 160 bucks. What I use here is a 15 cell matrix. What it shows you is different discount rates, so 8%, 9%, or 10%. So it gives you also a sense of sensibility of the model. So if you're requiring to make 8% on Visa, well, you can buy it at 300 bucks, and then it's still going to be a deal, which doesn't make sense much, right? But if you go at 10%, then you're down at 100. So it's not helping you making a decision. What will help you is that if you hesitate between Visa and MasterCard, then you run the DDM model with same numbers, and then you look at the P/E ratio, and it's going to be easier for you to determine which one is the best one. If you look at Fortis, a lot more stable, a lot easier. So 6% for the first 10 years, 5.5 go down the road. Intrinsic value is at 60 bucks on the Canadian market. If you go back up right here, DDM valuation tells you that there's a 15% potential of upside potential. So basically, in other words, what it tells you is that you have a good margin of safety. So once you have done your filter, select the sector allocation properly, identify the dividend safety of the stock, and going through the business model upside and downside, you're getting ready to process your buy. Don't do it right away. Now it's time to write down your investment thesis. And that is the most important part of the process. Why? Because right now, when you're about to buy, you're going to list all the good reasons why you think this company should deserve your money. You're working super hard for your money. You're making sacrifices to invest. This money must be used to a good investment. You don't want to lose anything. So you want to list the growth vectors, market shares of the company, competitive advantage, the metrics that you like, how it is positioned to thrive in the future, how it's going to react to the pandemic, for example. And all those reasons, when they're stuck on paper, and we do have it at DSR, for example, and I always come back at them when there's something shaky. Well, what I do is this will also become the reason to sell. So back in March, I look at my portfolio, everything was falling apart. And then I was like, okay, now I'm losing money. That's fine. That's something I have to deal with. I have to look at my portfolio and determine if I should make modifications. Should I sell a few stocks and buy new ones because the environment is changing? So let's go deeper into that. So I just read my investment thesis for each of them and then validate if it was still the case or not, if it's still valid or not. So if it's not valid, I just get rid of it. If it's not valid, sorry. So if it's still valid, no matter if the company is up by 150%, I'll keep it. And this way has allowed me to have shares of Johnson & Johnson over 100% in my portfolio, Lockheed Martin over 200%, Microsoft 150, Apple, as I mentioned earlier, over 500. Obviously, I have losers in my portfolio, but keeping my winners will make my portfolio thrive in the future, and this will make a big difference into each of my decisions. And this is why you have to write down your investment thesis and make sure that you have covered it all right when you're happy about the stock and when you're motivated to invest. Now, to end up the webinar, I have a few more slides before I go to the Q&A session. First one is a few random thoughts about what you say, what you think that could kill your returns, that could kill your portfolio. First one is, yeah, well, Mike, I need income, I like the yield, and this is what I need. Well, this is called a dividend trap, and most of the time you're gonna lose money into it. If the dividend is not growing, don't go for the yield. That's a huge red flag. You have to understand what's happening. There's no free lunch in finance. If a company pays you 10% yield, it's because there's a problem and you must understand it. If you don't get it, it's like you're sitting at a poker table and you don't get who's not the bad player. That's probably because you are the bad player. So you have to make sure that you don't focus on the yield. The yield should not even be part of your investment thesis. That's not a reason to buy a stock. I'd rather have shares of Visa and then having to be forced to sell a few shares to generate income than having shares of Macerich, which is Reits in the shopping mall center. It was actually rated a sell 2 years ago in 2018 at DSR. I'm not like picking cherries here. And this company, we didn't like it because there was no growth. I didn't believe in the retail sector, was rated as a sell. The stock plummeted big time. And a lot of investors were saying, you know what? I don't care if the stock plummets. I'm making money because I have the yield. And then one day they wake up, the dividend is being cut. So now they lose revenue, they lose capital, and there's nowhere to be. Second thing is, oh, the market is crazy, and I'll wait. Well, you know what? I'll tell you something. The market will always be crazy. If you look back in time, look at the past 20 years, and you're going to find a very excellent reason not to invest every single year. On the other side, if you have invested over the past 20 years, you made a lot of money. So never wait until it's better. It's settled down. There's no clear indication of that. A lot of people are talking about full position and half position. I like to have my company in my portfolio to have an impact. In the next slide, I'll tell you how many stocks I like to have in my portfolio. But I never go half. Because when you go half position, let's say you wanted to invest $20,000 in a stock. So you go 10,000 in Fortis and then you wait to see what happens. The only thing you're creating here is confusion and doubts and dilemma. Oh, should I wait? Should I put more? Oh, it's going up. I'm going to wait until it's go down. Or it's going down. Oh, yeah, I'm going to wait until it's go down a little bit lower. So you're just creating more noise in your process, and you will lack of conviction in terms of investing, and you're not going to make it out. Again, there's never clear indication it's a buy or it's a slam dunk or it's an easy trade. Those who are telling you are probably car salesmen, and you should never listen to them. There's always a part of risk. There's always something we don't know, and always think twice. If you think that this one is a sure bet, go for outside opinion that will tell you otherwise, and then you can make your head around it. Stock is overvalued. That's pretty much the most common saying after the market is crazy. This stock is never overvalued. This is the price you pay, and that's it. If you think a stock is overvalued, I've made the exercise several times. Go back, find your favorite analyst or your favorite writer or blogger or even yourself. Identify stocks in the past and the price that you thought it was the good thing, and then calculate your batting average. You'll see that you're probably going to be right like 1 times out of 10 for valuation in 2 years or in 3 years. We don't know what's going to happen. Don't waste your time too much on valuation. Put your effort on your investing strategy instead. Some random thoughts. So today you have a lot of money. You don't know how to deploy a large lump sum. Back in March, I was doing lots of private webinars with my DSR members, and I was telling them, invest 1/3 right now, invest another third during the earnings season that we just completed right now, and then invest another third in summer once everything will calm down a little bit, and then we will get the full impact of the COVID-19. Because back in March, we didn't know what was hitting us. I would say the same today, but have a plan, have a clear plan about that. Don't say, oh, I'm going to just put a little bit. No, if you want to do it like 10% every month for 10 months, that's fine, but make sure that you do it. Personally, I went all in. In 2017, I got my check in September. A month after, I was 75% invested, and by the end of December, I was fully invested. The only reason why it took me 3 months was because I was building the company at the same time. So I was focusing more on offering a great service instead of managing my own money. But even then, 3 months was more than enough. Percentage per sector, roughly 20% should be the maximum, unless you're able to find several subsectors like industrial rates could be interesting. If you're going for healthcare, it's going to be a little bit harder because the biopharmaceutical are taking a large part of it. Then you have medical appliances, but not too much. Don't go over 20. Try to diversify. So then you have utilities that will pay a steady income. You can have Canadian banks, same thing. You have growth from consumer, cyclical, and tech stocks and stuff like that. GFAD, you're asking for the 1/3 during the earnings, and the other one would be this summer, because this summer was not because it's summertime, but because it was long enough between March and June, July to understand what's happening with the economy and what's happening with COVID-19. Obviously, we're still in the dark for some stuff. We still don't know how it's going to fully impact the economy, but you have a better understanding. And you also had the time to read about COVID-19 updates from businesses, comments from CEOs telling you what's going on in their business. Great example here for Canadians, CAE. They are building simulators to help aviation and defense pilot. So they have roughly 45% civil aviation, 45% defense segment, and then a little bit of healthcare. Well, obviously their stock plummeted, but they shifted around, and now they're building ventilators for the government. So can you imagine that? So that tells you a lot about the business. And you know what? One day or another, airplanes are going to fly again, and this company will be around because they're so swift to shift their business model, find another way to make revenue in the meantime, that this is a great business that you want in your portfolio. All right, so size of and percentage of a position. I think that the best numbers of stocks would be between 30 to 40. That's enough for you to have a great diversification, to capture, seize opportunities when you see them. But at the same time, you don't want to go 65 or 70 because you're getting closer to an ETF, and it's impossible to follow your stocks quarterly. And I like to have my investment equally weighted as much as possible. So I have a few strong position like Microsoft and Apple because they just surged in my portfolio. I actually sold some Apple last week because of that reason, not because I didn't like the stock. I love the stock, but at 15% of my entire portfolio was too much, so I just sold a little bit. And so then obviously around 3% would be a good size for a stock. Room for speculative plays. A lot of people are just like, yeah, what about the airlines? What about the oil industry? And how can I make a lot of money very fast? I can understand it's fun. And I like to do it myself as well, but rarely over 5%, especially in times of uncertainties like right now. Sometimes I go up to 10, but when I go up to 10% of speculative plays is really because the market is going well, and then it's a little easier. Usually I go down below 5%. Right now I'm at around 4%. One of my biggest play right now is Brookfield Property. Brookfield Property lost roughly 50% of its value. Obviously, they have offices, retail, and then some family apartments. It's not doing super well in that in those sectors, obviously. But the thing is, they have super high quality asset, and they are backed by Brookfield Asset Management. So to give you an idea, Brookfield Property has $7 billion in liquid assets, in liquidity that they can have, roughly it's $2 or $3 billion in cash, and then the rest on line of credit. But Brookfield Asset Management has almost 60 billions in cash, 60 billions in liquidity, about 13 or 14 billion in cash. So yes, the price of the stock is already, they're already waiting for a dividend cut. So I didn't buy it for the income, but I think that this stock can go up by 30-40% very easily. Actually, within a week, I was making 20% profit, and then the market went down again, and then I'm like breaking even. But this is the kind of speculative play I like to have, and this will be part of my portfolio for 12 months to 24 months maximum. I have a specific investment thesis, and whenever I'll make like 40-50%, it's not like a long-term holding that I will always keep it. I'm just going to put a stop sell. If it goes over 50, that's fine. If it goes back down, I protect my profit, and then I move on. So this is how I manage this part. Now, to summarize, and I'm good, 55 minutes, right on target, I'm proud of me. So use your stock screener. I personally use the Dividend Triangle just to narrow it down. You can add a few more metrics, but keep it simple. The more metrics you add, the more doubts you're going to create. Then dividend growth is better. Dividend growers has been proven to be outperforming the market with less volatility. So if you're looking for companies that will survive and thrive, there you are. Focus on few sectors that you need in your portfolio. Don't go all in for one sector. You're going to get bite one day or another. Select stocks with strong dividend safety. Obviously, it goes along the same way. Company that are able to pay a stable dividend are a lot better than a high yield with shaky financial behind it. If you can tell the story to a 12-year-old, then you're in business, you understand what's happening, and you understand the upside and downside potential, and there you go, you have something solid. Now you have to determine if you want to add it to your buy list or you want to buy it right away. The buy list could be very useful, especially if you have it ready and then you have a loser in your portfolio. It doesn't meet your investment thesis, but it kind of feels bad to sell something at loss because you're just saying, oh, it's going to come back. I'm going to wait for a rebound. But the thing is that money's gone. You know, if you had an investment at $50,000 and now it's at like 25, you have $25,000 right now. That's what you have. So you have the decision to either invest it and keep it as the way it is, or take that money and go on your buy list. Which one is the best investment right now? This is the decision that you have to make. Finally, write down your investment thesis. It will grow your confidence, bring more conviction, and make sure that you remember those reasons when the market goes crazy, when there's noise everywhere and everybody tells you, oh, it's going to go down, it's going to be like deflation, inflation, hyperinflation, whatever, stagflation, you know, how deflation teams, the Fed is printing money like there's no tomorrow, the Canadian debt is too much. You know what? You shut that door, go back to your investment thesis, and then you feel good about your investment. And if you've done that, you haven't sold in March and you're still making money today. So those are like great things. So now is the time that I would like to welcome you to DSR. What we do at DSR is quite simple. We help you rethink your portfolio. We help you look at your portfolio in ways that haven't been done before in terms of sector allocation, in terms of strategy. We have portfolio models for you. Then we help you to buy the right assets. I've explained my entire buying process, but that could be summarized into two numbers at DSR. And when you look at how we publish the information right here, just want to show you that because it is very cool. And I'm super proud of that system. You know, you can go on the stock card page. We have US and Canadian stocks, roughly like over 400 total in our library. And our goal is not to keep all of them. So when you see they have pro rating and then dividend safety score, when you have a company like the Chimors that has a pro rating of 2 and dividend safety score of 2, after 6 months, that company is gone. So we accept start card requests from members and we add them and redo them. And then when you go, you can filter them through pro ratings. You can filter them with PE ratios, current value, and you can even download all of this in an Excel spreadsheet and then start playing with filters. They have more metrics on the site, but that will help you to identify the right assets for you, the best stocks for you to make sure that it makes sense. And then the only thing that you're left to do is to retire stress-free. You have a strong portfolio, you bought the right assets, you know how it goes. We have a weekly newsletter telling you what's happening during the market crash, and still going on right now. We have private webinars where I answer all questions to all my members to make sure that they feel safe, that they feel that we have their back, and that they can continue to invest. So that was a great tool that we have designed so far. So you have the offer right there below, $97 instead of $177. You keep your price forever as long as you remain a member. You keep that price. So $100 a year is nothing, to be honest, with all the information that you get. You make one good trade a year and then you pay for more than that, right? You can look at on the website, we have our portfolio returns that are pretty strong. Just to show you that for a second, then I'm going to move out to the question section. But if you go on the site, and you can go see that in the portfolio section, you will be able to see our returns. So you can see my personal returns that are published monthly through the newsletter and also on the Dividend blog. But we have like US portfolios, Canadian portfolios, retirement portfolios, aiming for income. And super important right there, you can see our portfolios returns and our benchmark. So what you will see, the benchmark is a mix of ETFs, the VIG and XDV. So basically two well-known dividend paying ETFs. Most of our portfolio beat the market by a wide margin. So right now you have this, like most of them, I think we have like one or two that are being outperformed by the stock market. Like this one, for example, retirement USD, we're lagging by like 3%, but that's about it. So we are having a very strong streak. Most of those portfolio has been created back in 2013. So yes, we went onto a good run, but it's one thing to be able to beat the market when the market is going up. But in 2018, we still continue to beat the market. And right now, we still continue to do very well as well. Everything is being based on the buying section, the buying process I've discussed today with you. All right, so now I have one more hour to answer your questions. So it's going to be quite interesting. Keep using the question below. The question below section, and then we'll go right there. So, hey, Connie from Vancouver and Chet from Atlanta. I hope that you have enjoyed that webinar. Now, thanks, Craig, for the comment. Now, Rick, and Rick, by the way, is like one of my favorite webinar participants. He's a member at DSR. He has those very strong questions. So thank you again for being with us, Rick. GFAT, if you want to pay with PayPal, send me an email. Vero, if you can do that, we can deal with that as well. We don't have it on the website, but we can accept PayPal on a manual basis. Thank you. All right, so Rich, Mike, I have a portfolio strategy question for you. I love it. You use V as an example of a great dividend triangle stock, but you don't recommend investing in Amazon because it doesn't pay a dividend. Do you really see a 0.6% dividend yield as a key difference between owning these two really strong growth stocks? It seems to me that Amazon will be paying a dividend at some point in time in the next several years. I really love that question. And actually, Amazon is my only non-dividend paying stocks. I also have a very small position on Slack, which is Work, because I just love their service. We use Slack at DSR all the time. But that's another topic. The reason why I discuss Visa and not Amazon, the first thing is the overall strategy is based on dividend growth, because that dividend growth, no matter what is the yield, will tell me if the company will continue to grow or not. The problem with stocks with like Amazon, right now it's quite obvious they're doing well, right? They're being built for the pandemic, and that's fine. But let's bring it back like 5 years ago. It's very, very difficult to determine what's going to happen with Amazon back in 2015. A lot of people didn't like it that much at that point. They were saying that the company was just burning money, and then it was trading at a ridiculous payout ratio. There was not even generating cash there. And all of those reasons makes it very hard to understand. And unfortunately, my strategy focusing on dividend growers will prevent me to invest in most great growth stocks. that are there, like Amazon. And actually, I came to invest in Amazon after reviewing Walmart and Target. That's the story behind it, and that's why I bought Amazon, because I figured out they will win it. I rather focus on dividend growth stocks for that reason. And at one point in time, you're never going to get those stocks that are skyrocketing, but at the same time, they can do very well. Like I mentioned, I think I have like 9 or 10 positions in my portfolio that shows 100%. And that is since 2012. It's not like for the past 25 years, right? Even Union Pacific, which is a railroad company, is over 100% in my portfolio. I actually advised people to look into it back in 2016 because it was highly cyclical. Railroads were down, and this is where I discussed that. So yeah, I think I covered it all. Thanks. Chet, you're asking about the industrial stocks that I named again. No, well, okay, so I'm not too sure. Chet, if you can join in the chat box and tell me at which point. The two stocks that we discussed was Fortis and Visa, but Fortis, it's a utility, it's not an industrial. One industrial I discussed today was CAE. Which Veronique actually put the ticker over there. It's CAE.to or CAE for US as well. Let me know if you have any question about any others. I'll be more than happy to cover it. GFAD, how do you rebalance your portfolio? If you have a great opportunity at a cheap price, for instance, options of Broadcom, AVGO, you said over one of your portfolio, what would you recommend to choose? In my case, I usually invest more in the ones I have, but I feel I doubt too much in selling. And then Archer is adding, avoid overexposure. And I think this is a key part. Thanks, Archer. Archer is one of the great dividend growth investors at DSR Pro member as well. So thank you for being here today with us. Yeah, the key here is I look at my portfolio every quarter. After each earnings season, I receive my DSR Pro report. I take a look at it. I look at my asset allocation, and then I look at each stocks, what happened in the quarter, if they fit my investing strategy, and then I look at my exposure. You have to decide if you're comfortable having one stock with 10% of your portfolio, for example. If you're not comfortable, and a good idea is to say, okay, let's say you have $40,000 in Microsoft, which on the portfolio that is at $400,000, so 10%. How would you feel if Microsoft lose 50% of its value? And this could happen for any stock. So if that stock goes from 40,000 to 20, how are you going to feel about it? And this will determine your exposure. And if you feel good about it, well, then you know that your trigger is over 10%. And this is what I did with Apple. At 15, I didn't feel comfortable. I want to bring it back to 10. So I sold for 5% of my shares in Apple, 5% of my portfolio worth, basically, and decided to distribute it elsewhere. And this is why I know when it's time to sell. If not, it's whenever the company doesn't meet my investment thesis. So most of the time, I'll keep my winner for a very long time. The only reason why Apple surged too much is because it went up by 500%. So at one point in time, I'm too exposed to this one. If Apple becomes the next BlackBerry one day, well, I'll be happy that I've sold some stocks over there. Rick, you're asking if Fortis is your favorite Canadian utility, how do you rate Canadian utilities, CU and AQN in comparison? I'd say that Fortis is among my favorite. I really like Algonquin as well, mostly because they're more on the green side. So I think it's they're developing more green power. So I really like AQN for that reason. CU, a little bit less, and I'll tell you why. It's actually the longest dividend grower in Canada, not only among utilities, but across the entire market, Canadian market. The problem is they still rely a lot on the Alberta economy, and I don't see this part to be great in the upcoming years. This is why I like Fortis exposure. Algonquin, the same thing. They're actually, even Algonquin are paying their dividend in US, but they both have exposure to the US market as well. And I like a little bit more Fortis for its long dividend growth history compared to AQN, but that's about it. I think both of them are very great. Another one that I like a lot is Emera. Emera, because they have strong growth vectors in Florida, exposure in Florida there. And what I like is, you know, they had the Maritime Link project, and they were able to manage it, built it under their budget. So it shows very strong management over there, and obviously the dividend is great as well. So those would be my three favorite: Fortis, Algonquin, and Emera. Canadian Utilities, not a bad pick, but treated like more like a Telus bond, where the yield is very strong, but growth perspective are a bit limited compared to the others. Julio, in your process of stock selection, do you incorporate technicals or mainly fundamentals? I don't integrate anything that is technical. You know what? For me, when I look at technical guys, most of the time they will tell you what worked, but they're never going to tell you what is going to work. And this is just like adding more noise to my investment process, so I don't use it. And I think that if there's one message I want to go through today is, regardless, it's completely fine if you want to use technical analysis as part of your process, or any other metrics that I don't use. That's totally fine. But keep it to a very narrowed numbers of factors and stick to that over the long run. This is where you stop creating chaos and confusion and doubts in your investment thesis. You know, when I use DSR and when I make a decision, it takes me like not too much because the work's already done. But the same day I analyze a stock, I can usually make a transaction on it for that reason. You have to invest with conviction. This is the only way that you're going to be able to build a solid portfolio, and don't doubt yourself all the time. Jagdish, when do you sell the dividend stocks? A few companies have cut or stopped their dividend. I have 3 rules to sell stocks. First one, if it doesn't meet my investment thesis. Example, I bought Bank of Nova Scotia several years ago based on that great story that they have international exposure. I love that story. I think that it's great. Latin America GDP growth potential is a lot better than in North America. So I thought, you know what? They're big players. They can rely on their stable business in Canada, and they can expand with more growth international. Love the idea. The story runs well. A couple of years after, I realized that they're not outperforming other banks because they are in Latin America. And then when I traveled there, I realized that it is pretty much difficult. Banking system doesn't work the same way. People don't act the same way. And then it doesn't fit my investment thesis anymore. And I was actually making money when I sold Scotiabank, so that wasn't the point. The point was it's not fitting in my investment thesis. So that's the first one. Second one, dividend cut or dividend suspension. Today is the one and only moment where I have to put an asterisk, a little star to that rule. I've kept my shares of CAE. I've kept my shares of Disney for that reason. Why? Because they don't cut their dividend because they have a flawed business model, or they have poor management, or they're just losing market shares. They had to cut or suspend their dividend because the business was closed. And it was forced to be closed because of an uncontrollable event. And that makes a huge difference. You know, a lot of companies that cut or suspended their dividend were already rated as sell last year and 2 years and 3 years ago at DSR. Why? Because we didn't like the business model, the growth wasn't there, and we could see that one day or another they would cut their dividend. Now is a great time for energy businesses to cut down their dividend, but the reality, the truth behind that is a lot of oil and gas companies were struggling since 2016 when there was an oil bust. So 2016, 2017, 2018, still having problems, but the market is going up, so nobody cares, right? And now they have the perfect timing saying, you know what, now the demand is not there, we just cut our dividend. And they're not going to go back because they don't have a strong business model. So that would be the other reason why I do it. And the third one is what I discussed earlier, overexposure. So my room of comfort personally is between 10 to 15%. It's still quite aggressive. A lot of people would probably not feel that comfortable, probably more around 6 or 7%, because when one stock is going sideways, it kills your portfolio. I've seen a lot of people. I used to be a private banker for 10 years, taking care of like basically high wealthy clients with high net worth, and had like clients like that were like they were executives for big companies, and they had like huge stack of shares of companies, and they're just saying, yeah, well, I've worked there, I love the business, this and that. So they have like 40% of their portfolio, they have like, I don't know, like $1 million or $500,000 in a specific company, and then companies going down, lose 40%, and their retirement plan goes to bust. So you want to avoid that. Rick, you made a great point about not overreaching for REITs yield. What do you consider safe FFO and AFFO payout ratio for REITs? You surprised me with your 30-35 for portfolio limit for REITs for retirees. Well, as I mentioned, for the 30-35% in that sector is if you like, imagine that you have roughly 10% in warehouses, another 10% in apartments building, and another 5-10% between cell towers, data centers, and stuff like that. Then you'll be fine. I mean, you won't even touch the shopping malls. You can, and then if you want to add like one shopping, not shopping malls, but like stores or something like that. In Canada, for example, we have those that are anchored with grocery stores or pharmacy, which they will do well. They're well rated at DSR as well. So you can reach 30-35% that way. Obviously, it's not ideal, but it would work and it would generate income. In terms of FFO and AFFO payout ratio, I think that they can go pretty high, because I've seen a lot of REITs, they were able to maintain a 100% payout ratio for a long time without doing anything. Then it would be more looking at the art part, say, are they growing? Where are they going? A great example would be Boston Pizza. At first, when we created the retirement portfolio, that was created, that's a young portfolio, it was created in 2018. Boston Pizza was part of it. And then after a few quarters, the FFO payout ratio was always like around 100 or 101%. And then you have to consider that some of those REITs, they are a lot of investors are using drips. So basically, they don't have to pay the full dividend. They pay with more units. So 100% payout ratio is manageable for those, because the real payout ratio is more like 90% or 85%. And what we realized at one point is the business struggled to grow, and the payout ratio was always high. And after a few quarters, we decided to sell, and we sold it a few months before they cut their dividend. And we took a small loss, but it was a smaller one than if we would have waited for the dividend cut, and then we would have been hit big time. So I would say anything under 90 is perfect. Between 90 and 100, you have to dig a little bit further, but I would still be available to buy one with a 95% AFFO payout ratio. It depends on the rest, like the rest of the analysis around it. Jagdish, are most of your dividend stocks buy and hold? Yes. When I buy a stock, my goal is to keep it forever. Unfortunately, it's not always happening. As I mentioned earlier, I sometimes sell because the investment thesis doesn't work. I do make mistakes, obviously. Nobody can always be 100% everywhere and never make mistakes. Even Warren Buffett did some pretty huge mistakes, actually, even recently, with the airline things and so on. So the thing is, you have to have the bulk of your portfolio to be stable and to be focused on dividend growth, and those I'll keep them forever. When I shifted my strategy towards dividend growth, that happened between 2010 and 2012. Most of my holdings that I bought there back then, Coca-Cola, Johnson & Johnson, for example, I think Canadian National Railways was bought around those times as well. I still have them, and if the investment thesis doesn't change, I'm going to keep them forever. Miro, why Visa, not MasterCard, Discovery, and Amex? Well, actually, I like Visa and MasterCard. I prefer Visa because they're the #1 player. But honestly, I would not go into a hard debate between MasterCard and Visa. They're pretty much two great businesses, and I decided to pick Visa, but there's not much a big difference, mostly because they're the #1. Discovery and Amex is completely different because they also have a loan portfolio. They also take the risk of loaning money, and that is obviously a super big problem right now. It's less important for Amex because they're dealing with wealthier clients in general, but Discovery is like the everyday card. So this could be a problem in an event of a recession. Oh yeah, damn, we are in a recession, right? So this could be a very problem. Instead of like Visa and MasterCard, they're just payment networks. So that's the big difference. Marnie, what document shows FFO and AFFO figures? What's the best way to find these documents? Rick, you're saying company financial updates are one source. Use a fast graph for a quick look. Yeah, it's a subscription service. Great service as well. Actually, Rick answered pretty much the question. You can have, when we're talking about FFO and AFFO numbers, we're always discuss it in the dividend growth perspective segment of the stock cards, because I know that you're a member too, Marnie. Thank you for being here, by the way. But if you're not a member and you don't want to pay for it, the best solution, just go to the quarterly presentation of any Reits, and you'll have it. And that is one thing also I want to mention, because there's like Enbridge, for example, which is a pipeline company, will not use the payout ratio, but rather the distributable cash flow per share. You will find that information always inside their quarterly earnings or annual statements. So this is where you have to go if you want to get the information, not that will be the most accurate information. And usually in the presentation, what is good is that you're going to have several quarters or years where you can see it going up and down, and then you can make yourself a good idea of what's happening with the business. Rick, you mentioned interest rate. What is your best guess on the direction of interest rate for the next 3 years? Will they stay the same, go down, or increase? Rai says, no one will really be able to answer that, but I believe the US said that they'll be keeping interest rate as is until 2022. That's pretty much what I remember as well. Canada should follow. Yeah, so now back to my point of view on that. You know, the way that rates are being assessed by any central banks, but mostly we're going to look at Canadian Bank, Bank of Canada, sorry, and the Fed, is they look at what's happening on the economy, right? So instead of knowing what's going to happen with the rates, you have very good indication if inflation is going up, which is not going to happen right now, and if unemployment rate is going down fast, which is not happening right now. So those are factors that you can look at trends, and then you can pretty much guess when they will change their mind. The Fed said, well, we're going to keep that until 2022. You know the reason why they did that? Because they want to reassure the market. The market is always trying to take all the information known today and send it 10 years, 15 years, 20 years in the future. And this is a big problem, obviously, because information changes all the time. So when the Fed says, hey, guys, don't worry about the rates, it's going to be stable, it reassures the market. It makes it easier for them to run their calculation and trade. This is why they did that. Imagine that, because right now this is not what we're seeing, but imagine that jobs are coming in strength towards the end of 2020, and then in 2021 we still see that that going up, and by mid-2021 the economy is booming again. Then we're going to talk about increasing the rates at one point in time. This could change rapidly in terms of the next 3 years. The big unknown that we don't know right now, and this is why I cannot tell you what's going to happen with rates, is What is the impact of the COVID-19 if there's a second wave this fall? I mean, we've seen several states reopening not too long ago, and with Memorial Day, we see like cases rising up in there. Stats in Florida and Texas are not looking so great right now, and a lot of people are starting to get shaky on that. I live in Quebec, so if you've been wondering for the past hour and a half, well, man, this guy has an accent. Where is it coming from? It's because I'm French Canadian, English the second language. So in Quebec, we were the first province to reopen. We're going to actually reopen gyms next week. My sons are going to play soccer this summer, so it feels like now they're opening like full time. What's going to be the impact of that? Well, unfortunately, we'll know that in August, and this will be a big determinant of what's going to happen in the economy going forward. All right, so I have 35 minutes left, 12 questions. I'm going to try to be a little bit faster on the next ones. Ryan, what are your thoughts on Comcast and AT&T, and not Telus, obviously? So many people like AT&T, I'm assuming because of the high yield, but barely any growth. Shouldn't people be concerned about the payout ratio? The thing about the payout ratio in AT&T, right, is you have to look at its ability to generate cash flow. Their cash payout ratio is actually a lot lower, and this is why it makes it a great investment. I am not like right now. It is. I think it's a buy considering the price, because it was affected. But actually, people will need wireless services and they will need entertainment. So I think AT&T is very, very well positioned for that. So this is why right now I see it as a buy. And if you want to look at that, and I'm just going to share my screen a second because I love that tool. Go back in AT&T right here. You'll see payout ratio super high, as you mentioned, 103%. Cash payout ratio, 55%. So its ability to generate cash flow is just very strong, and this is why I'm not worried about this dividend. And AT&T CEO just declared that they will have a cash payout ratio of like 60% by the end of this year. So great thing. I don't like too much Comcast because they depend more on advertising revenue, and we all know it's going to be low in the upcoming quarters. So it's going to be a lot more difficult for them as compared to AT&T. So that's why I would prefer AT&T, and I would actually prefer Telus over Comcast if you ask me. GFAD, what are your thoughts about using ETF to gain more exposure on certain sector, gain more dividend income? I'm not against ETF, but I don't see I don't see the point of investing in ETF myself. I'll tell you why. When I look at an ETF, I look at their top holdings and I always find companies that don't fit my investing strategy. And for that reason, I don't want to go the ETF route. If you have the time, the knowledge, and the interest to look into financial statements and do like similar process as I just showed today, you should go with dividend stocks. You're going to outperform ETFs. If you're starting to invest and you're unsure and you want to have immediate exposure to like a well diversification, ETF is a great way to start. I just find that there's a market for both. It's like I have a Jeep Wrangler. I love my Jeep. Like in summertime, I take off the roof, I take off the doors, and I just love it. But you know what I don't like about it is whenever there's a light flashing on the board. I have no mechanic skills, no interest, and no knowledge about it. So I will do more harm than good if I open up the hood and try to repair it. So whenever it happens, I take the Jeep, I go to the dealership, and I just don't care about what's happening, and I don't care about paying fees. So that's why ETF, if you don't want to commit yourself to your portfolio, ETF is a very great way to invest. And Rick, you're adding, it can also, if you're interested in something outside of your competence, that's very interesting. International stocks, you're interested in emerging markets. You want to have 5% exposure to small cap tech stocks, for example, that are set to surge, but you don't know how to read those. You can use ETF for that. That's a great complement for your portfolio as well. Right. In Canada, there's a lot of talk about wide mode companies, Canadian banks, utilities, railroad, energy, telecoms. What are your thoughts on those? Would it be a good start to point portfolio before looking into the numbers? Actually, yeah. I'm not an energy guy at all. I don't like energy stocks. Actually, the only two that you mentioned, TRP and Enbridge, I think it's the only two companies that are actually rated not as solid at DSR. They rely too much on the oil market and they have like no control over that. So that's just too bad. For the other strong mode, we're talking about banks, utilities, telecoms. You can put like some rates into that because it's very stable. I think it should be the basis of any Canadian portfolios. You mentioned all of those, and I have like stocks in all of them as well. This is a great start if you want to start your portfolio today. You're looking at the Canadian market, go there, but then don't forget the U.S. market. U.S. market is well diversified, and you won't be able to find international companies giving you international exposure. You know, like the Coca-Cola, Johnson & Johnson, Procter & Gamble, Colgate, Palmolive, all those classic names, and then you have all those big tech stocks that you can't find here. I mean, if you want a tech stocks that paying dividend in Canada, you have three interesting choices, which are Sylogist, Henhouse, and OpenText, and that's it. You look at the US, and then you have like a dozen one that are interesting. Thoughts about Alimentation Couche-Tard. I just love it. You know, Alimentation Couche-Tard is a perfect model of growth by acquisition. They have developed such a strong expertise there. Funny story, now fuel sales are going to go down, obviously, but you know what? They will be selling so much tobacco and so much wine and beers over the past couple of months. Their earnings are expected on the 29th of June, which should be very good. I have it in my portfolio as well. And what's going to create this pandemic is going to create quite interesting is pretty much a lot of convenience store chains are going to go down. They're going to struggle and having problems because of the recession. And then Alimentation Couche-Tard will turn around and do what they do best. Buy them, integrate them in their model. You know, like some people, I think it was Ron was asking me about the picture right there. That's picture I bought in Hanoi during my trip in Vietnam. We I love traveling. We spent 1 month between, actually we arrived on January 2nd and we left January 31st, Vietnam this year. So perfect timing to avoid the COVID over there. But yeah, long story short, we were walking in Hanoi, and most of the convenience stores were Circle K's, were Alimentation Couche-Tard brands over there. So I just felt like home, and just gives you an idea of how they can go international as well. They had planned to buy a huge convenience store, Caltex, if I remember correctly, the name, in Australia. Didn't go through. It might be a better deal later down the road for a long time. All right. So, David, what signs do you use to discard a stock as a dividend trap? For example, a company that didn't have revenue growth in the last 5 years and has a good yield would be a dividend trap, right? Actually, David, you pretty much summarized it. It's a little bit, you have to go a little bit further than that, but it's not just the metric of the revenue growth, but more like, is the company has growth vectors right now? Great example I can pull out of my head, Iron Mountain. A lot of people are saying, oh man, that's a great REIT, you know, because Iron Mountain used to be the king of filing papers, you know, those huge carton box. If you have worked in an office, you have them all the places. So basically their business, they're taking all your documents and they're storing it somewhere, but physical documents. You can imagine that this business is crumbling, it's plummeting, but a lot of people, they're just like, yeah, well, they have that huge rate. Like they're offering, I think it was like what, 7 or 8% yield right now, because they are moving towards data center, but they're like so far behind, and there are like so many other players over there that my guess is their revenue are still going to go down because their data center is not going to be able to grow fast enough to compensate for their dying business. So that would be perfect case for a dividend trap. But yeah, I would say anything over 5% yield, it's a red flag. It doesn't mean it's a bad stock, but it's a red flag. You have to wonder why in an environment where there's no rates, there's nothing, this company is paying you 6, 7%, 12% rate yield, right? So then you have to investigate and look at what's happening. If they don't have growth vector, don't fall for the yield. The yield is nothing. You know, a company can cut a dividend at any time. It's not a guarantee. It's not a commitment. It's not even an obligation for them. It's nothing. So you want to make sure that the company is able to grow. Thanks, Rick. Well, at 9%, it's a big no-no, that's for sure. Cindy, fairly new to investing, bought GDCom and BM Bristol Myers, I think. Yeah, BMY. When I first started a year ago, but I've done well. So congratulations, good stuff. Bit wondering if I should sell some JD to increase dividend on BMI. Still see good growth potential in both. Cindy, my answer would be the same for any companies. I'm not too familiar with how JD.com is doing, but if the reason why you bought them in the first place are still there, then you keep them. And if they're not, then you sell them. And then if you're unsure because you were starting, and that's sometimes the problem when you start investing. And I remember when I was back in 2003, I was pretty much like buying and selling everything, but I was not having like a full detailed investment thesis for all of them. And this is why I did a lot of like great business, great investment, and some others that didn't go too well. If it's the case and you're making money right now, take the time to build an investment process and an investing strategy. By the way, when you look at I didn't even mention it, but free workbook right there, Véronique, if you can copy paste the link in the section. If you actually go on the sales page, you'll be able to download it as well. This is a workbook that will help you to build your portfolio, build your investing strategy, and then after that, you can sell your shares and remodel your portfolio according to what you thought it was good. Tenzin signed up and excited. Oh, hey, that's cool, man. Well, thank you for your trust. By the way, if you don't like DSR, if it doesn't fit your investing strategy, or you find that it's not going to work for you, you have 60 days to ask for a full refund. I'm not here to make money off your back. I'm here to help you out, gaining confidence and reducing the noise of the stock market. If I cannot give you that confidence in your portfolio and reducing that noise and help you retire happy, I don't want your money. So you're always welcome to ask for a refund if it's not working, but thank you for your trust. Appreciate it. Leo, how do you distribute your position? Do you do it per account, or do you see it as a whole? Oh, that is a super great question. I have it from time to time. Thank you, Leo. So basically the question is, okay, Mike, I have like 3-4 accounts, different accounts. Some are tax sheltered in a way, some are not tax sheltered, whatever. In Leo's case, he's Canadian, so we're talking about RRSP, TFSA. Let's say you have a non-registered account as well. If the goal of those portfolios are the same, you should combine everything at the same one to manage it. So what I show on my blog is my pension plan account, which is a Lira, so I cannot add money into it. I just have to deal with that $108,000 that was given me back in 2017. By the way, now it's over $150,000, even after 2 crashes. So just to give you an idea of like my performances. But when I go back into my computer and I look at my investment, I will also include my RRSP into that and make another pie chart of my sector allocation and look at it this way. It's very important because you should do that, and then you can use different type of account to do tax optimization. For example, US dividends are taxed in a TFSA at 15%. There's their withholding taxes. There's none in RRSP. So if you look at the entire portfolio, you want all your US stocks in your RRSP and Canadian stocks in the TFSA, for example. But I look at it as a whole all the time. If it's the same goal. If your TFSA is to buy a vacation property or go on vacation every 3 years, well, then it's completely different, and then you separate both of them. Another example, I have obviously RESP, an account for my children's tuition when they reach university. My oldest one is going to 4th year of high school, so it's getting closer now. So this one is managed separately. Obviously, still dividend growth stocks, still 100% invested, but I will look at the sector allocation alone for this one, not joining into the rest of my holdings. Philip, I am very, very new to dividend stocks and currently have 401k, so retirement account. How should I begin with dividend stocks and how should I start with? I currently invest 10% in my 401k. Thanks. Actually, Philip, downloading this free ebook, the recession-proof portfolio work guide will give you a complete strategy. The first thing that you need to do is to establish your investment strategy. With your investment strategy will include a buying process, obviously, and then you can start investing. If you're just like pulling out filters and having fun, it's all cool, it's all hype. And I've seen a lot of millennials. I love running, okay? And I was running this morning, listening to a podcast from, it's called The Journal. So it's from Gambling and the Wall Street Journal. And they were talking about millennials using Robinhood to make like very aggressive trades on companies like Hertz, for example, and stuff like that. It's always cool because they were interviewing a kid, like he was 23 and he made like, he doubled his money, put $50,000 in Hertz, and then within a week he made more than 100% return. And it's all great and it's fun and stuff, but that's gambling. And if you start this way, it's going to turn out bad. Interesting enough, they forgot to mention on that podcast that during the same week, there's another guy that invested with options in Robinhood and invested like $100,000. The next morning he woke up and he was losing $700,000. So he went from 100,000 to minus 700 overnight, and then he unfortunately commits suicide. So it's very important to have an investment strategy that you understand what you're doing. Because if you don't, whenever the market's going to go up or down, you're going to panic and then you're going to make bad move. You're going to sell great investment because you made a little profit on it, and then you're going to keep losers or you're going to sell everything. So start with the book. I think it's your best bet, and then it's going to be a lot easier. We do a lot of coaching at DSR as well through the newsletter and the webinars. Obviously, if you think you had value today, you're going to have a lot more at DSR, that's for sure. Harold, great webinar. Well, thank you, Harold. There are a few Canadian IT stocks available and even fewer that pays dividend. You like the smaller cap Silogist? Yes. However, they just started a strategy review in March with the announcement of a long-time CEO retirement. Any concern going forward? They are on my watch buy list. Appreciate your comments. Yes, there were a lot of change in management, a lot of change actually in changing their compensation as well. Revenue didn't grow as much last year. It was a bit of a disappointment, so the stock went down a little bit. And you have to be careful with smaller cap because there's less information and there's higher volatility, so you have to make sure that you understand that before you press the buy button. What I like about the Silogist is last quarter, they increased their dividend by 10%. They also, the numbers were good. They were on target, and it's a very solid company. They have no long-term debts. I mean, that's crazy, right? And they're working similar to OTEX. It's recurring revenues. So for those reasons, I'm feeling very comfortable with that. And CEO retirement is one thing. But if the company is well managed, it won't be a problem. Look at Apple and what happened with once Steve Jobs handed over to Tim Cook. I don't think Tim Cook did a bad job, right? So there's always place for something great. Ronnie, do you believe there's enough solid U.S. dividend stocks to keep a larger portfolio, like about 33 or so that no stock is over about 3%? Or do you think that is too big of a portfolio? Oh, not at all. At DSR, we have, like I mentioned, we offer like 25, 100K, and then 500K portfolios. The difference between the three of them is only the number of stocks. So if you're starting, we're talking about 10 position, and then as you grow towards 100K, go for 20. And then at 500, we have 30 stocks. I personally have 34 stocks across all my accounts. I think 34, 35, not more than that. I have a value of like $300,000 right now. If I had 3 million, I would stick around between 30 to 40 stocks. That's a perfect balance for being able to follow all your companies quarterly, having a great diversification and not being hit by something that you didn't see. 3% weight per stock is great. I hate when if you make a super good move and it weighs only 1% of your portfolio, you don't even feel it. So at 3%, it feels good. So it's good. Yeah. So 33 for a large portfolio totally makes sense. US market is the largest, more diversification. You have international exposure, and you can always look around to Canadian side for banks and telecoms. They all trade actually on the New York Stock Exchange, so you don't even have to bother having a Canadian account. Jazz, do you look at debt level and credit ratings in your analysis? What I will look, especially right now, is the balance sheet and their current ratio. I want to make sure when companies are not doing so well because they're forced to close, I want to look at their cash and equivalent and their short-term their short-term obligation. The other thing I will look at is how the debt trend is going. So it's always going up. They better show me strong revenue growth and strong earnings growth and strong cash flow. If it's not coming this way, this means that they're racking up debt, but they're basically wasting money, and that I don't like. So I want to make sure that I have both a good balance between those. Credit ratings, not too much. I don't want to limit myself for companies that are not rated. So for that reason, it's good when you look at it. But as I mentioned, if you look at companies with strong growth vectors, usually when you come to the debt analysis, it feels good and it's under control. Nancy, do you evaluate ETFs as well? Unfortunately, we don't. There are too many ETFs that is not feasible for us to look at, to be good at everything. We like to be good at what we do, and what we do is finding dividend growth stocks, so we don't cover anything else. And that's also the reason why we narrow down our stock library to 400 stocks. And honestly, if I was just me, I would probably have only 100 stocks, but I know a lot of people tend to disagree with that, so they want to get a little bit more new ideas. But really, I have about 100 stocks that I really like, probably less than that. So I'm not going to go the ETF route for that. Thank you, Cindy. I love the blog, emails, and soon love DSR. That's crazy. Thank you for your comments. Grumpy Bear. I love that nickname as well. Don't you think Calian Group is not a Canadian tech stock? It pays dividend. It does, but it doesn't increase it, and I don't like that part. It actually kind of funny. Calian Group was part of our DSR portfolios back in 2013. We had a great ride, and at one point we decided to sell it. The company's doing well, but I stopped following it because of the lack of dividend growth. Sometimes it sucks. But when you are focused on your strategy, there's two things that's going to happen. The first one, you will have to let great company go, not even look at them. But the second thing is your strategy is going to bring you where you want. When I drove from Montreal to Costa Rica, obviously it was a 6-month trip to go all the way down. And we knew that we would end up in Costa Rica, but we didn't know the entire route. And sometimes you have to focus on your plan, and during rough days, during rough times, all the family, we came together and we were looking at our objective to go in that villa we rented for 3 months in Costa Rica. And we said, we're 30% there or 50% there, or in 2 months we'll be in Costa Rica. So it's a bad day. We have to focus and keep going. You cannot be distracted by what's happening outside. So I stick to my strategy, stick to my gun. It has played well, and I think that's the key. But yeah, definitely Calian Group was a great stock in our portfolio for a while. Charlie, for a retiree, would you recommend CEF, monthly dividend payment, but rarely increase their div rate? I don't like those package funds or closed-end funds for this one, mostly because you're paying fees that you don't necessarily look at, and you have holdings, or sometimes you have strategies that you don't clearly understand all of it, or you have options and stuff like that. Sometimes it's just CEF funds, classic, they hold stuff. But then I've received a lot of emails from followers or from DSR members asking me about, this CEF, whatever. And then I pull out the holdings and I'm like, yeah, well, they cut their dividend because look at their top 10 holdings. They're not great. They're not good businesses. And keep in mind, and I know it's hard. It's very hard for retirees, but $1 is not $1 in dividend is not magic. It's going out of the business. Sometimes you're better off with a well-diversified portfolio, lower yield. Let's say you have a portfolio generating 3%, but you're selling a few shares, and then you're still going to feel good about it, because if I have to sell shares of Microsoft in my portfolio to bring back my yield from 3%, which it currently is, to 5%, I don't mind. I'm making money, because if the company is paying you a 5% dividend, it's going down by 5%. So it's the same magic. It's the same logic. So you just have to make sure that you get that as well. So not a big fan of CEF. Marty, what are your current thoughts on UPS? UPS is going to obviously enjoy stronger volume, but it will come with another headwinds, meaning that there's a lot of home deliveries right now. What I like about UPS is that they're the largest player and they're the more efficient. So yes, they will have to compete against Amazon. But you know what? A few years ago, DHL was in the US against FedEx and UPS. And because FedEx and UPS were so great at managing their margin and having such a strong network, that DHL decided to leave the country. DHL, sorry. So it's not my favorite pick, but it's a stable, solid dividend stock. Arthur, what is the difference between DSR and DSR Pro? Oh, thanks. And then another Arthur says DSR Pro gives you a quarterly personalized portfolio report. I'm gonna actually show that to you quick while I talk. Basically, DSR members will access everything on the website. So we're talking about portfolios, stock cards, newsletter, webinars. It's all for everybody. And then what you will get with DSR Pro is every quarter, we're going to rate your portfolio. What that means is, I'm going to share my screen right there. Whoop, no, that's me with a big face. Sorry. There you go. Share my screen. This is what I want to share. And we're going this way again. Okay. So, not working. Sorry. Oh, there you go. Okay. So, right here, this is my portfolio analysis. So what you're going to get, I'm going to put that a little bit bigger. So the first one is you're going to have the sector allocation, your average yield, the number, like the average payment, and then you're going to have your pro ratings, your dividend safety score. We're going to highlight those that have weaker scores. We're going to give you a full portfolio of your holdings. So you can see what I have in my pension plan portfolio, the rating and the weight of each position. So you can see I was talking the real thing. I'm talking about 3%, 4% for most of them. Obviously, Apple did so well, it's a little bit higher. And after that, what is really cool is you're going to have a summary of what happened in the quarter. So you can access the press release, stock cards if there's one. You have the CEO comment, what is our analysis, or like part of the press release that we think that is important, declare dividend, revenue, and earnings growth. So you basically have all the information that is important for you to take action, instead of like going across tons of noise, tons of financial statements. We're just going to tell you, hey, look at this one, look at that one, and then there you go, boom, you have like the stocks that you need to, that needs your attention. The others, they're good, you don't have to worry about them. So it's very easy. Every quarter I receive my portfolio pro report, and I look at that to manage my own stuff. Great tool, and we're always trying to increase it, improve it. At the end of the quarter, we send a list of all stocks that are rated buys. We rate roughly 1,000 stocks now. It's a huge universe. So you get that list, nobody gets that. So you get the buy list and the sell list as well. Over time, the buy list on average outperformed the market, and the sell list greatly outperformed the market, meaning that if you sold those shares, you're way ahead if you have kept them. So that was great. During the crisis, I think we outperformed by more than 10%. So this means that our sell lists were down like 40%, while the market was down 30%. So this is a lot of money saved and a lot of headaches saved for you. Okay, last two questions, 7 minutes. Thank you so much for being there with me. Martin, I've currently chosen 13 dividend stocks on the TSX and plan to buy as many shares as I can with $100 each. Is 13 too many for $100 a month? Just make sure that you're not paying commission. I hope that you're with, I think it's Wealthsimple, because if you're paying $6-7 per commission, it's going to be quite expensive. But yeah, if your goal is to invest all the time and put more money into it, you can start with $100 a month, and then whenever you have a pay raise or you pay down a debt, you increase that money to 150 and 200. This is the way to start. This is the great thing. Maybe if you want to start by $100 a month for the next 12 months, you might want to go with an ETF like XDV.to. This is actually how I started my two older kids. I have a daughter, Amy. She's turning 13 in a few months. And my oldest son, William, is turning 15. And they started investing in 2019 through my TFSA account. And I made them buy two ETFs, so VIG and XDV. So they're two dividend growth ETF. They're starting, I mean, they're like $15 a month each, so $30 in a joint account. Not too much, obviously, but they get starting. They understand how it goes. So probably that it will be interesting to just build a little bit more. And once you have like $4,000 or $5,000, then you can move. But make sure that you don't pay commission on all trades, because it's going to be bad. It's going to hurt your results. Oh, sorry, there was a comment. I didn't see it. So if it was important, just comment again. I just click on the button by mistake. Sometimes I do that. Run, I'm 53, have money in questionable products, and this pandemic forced me to slow down and found out I'm very poorly managed with my advisor. I really feel sorry about that, Run. That's heartbreaking, actually. I hate when advisors are not doing their job. What can you do for someone in my position if I join? What can I do? The first thing is you will have portfolio models, so you can compare your portfolio in our models, and then you can start with that. And then you can use your stock cards to improve your portfolio. Using the DSR portfolio workbook will help you a lot to understand how to manage that money. We do private webinars all the time, so you can ask me questions all the time. As you can see, I'm quite generous with my time, and I really don't mind. You know what? That's the part that I miss from being a private banker, is to meet with clients. Right now, I have this opportunity of feeling with you guys right now, and I just love it. So you can ask me questions. Obviously, it's never going to be recommendation. I cannot do one-on-one. What I offer for DSR members only, and a very limited amount of clients I do that, is private coaching. So I teach you how to fish. If you're curious about that, send me an email. We'll discuss it together. I do that like 4 or 5 times a year, so because I don't want to take it too much of my time. But at the same time, I feel that it's so important to make sure that people are well invested and understand what they're doing. That's the reason why I do it. So hope that answers your question. And you know what? Take a look around. I'm telling you, if you don't like it, you send me an email, say, hey, Mike, it doesn't make sense for me. It's not working, and we'll apply the full refund. So you don't have problem with that. All right, Bill, what's your opinion on beat the TSX strategy? You know, it's like the dogs of the Dow. So you're buying like the low stocks, the underperforming stocks, and then historically it works, but I find it's kind of like too simple of a rule. It's just and then yes, it's an automatic autopilot strategy, but I prefer to choose my own stuff, and this strategy is based on the thinking that we believe that all stocks that were beating down were eventually going to go up. But at one point in time, you're going to have stocks that are going to go down and never going to come back. And you don't want that, right? You don't want that. But that happens all the time. So I prefer to own my stocks, and I'm not too keen on trading heavily. I'd rather stock on even my portfolio DSR, or my own portfolio, 2-3 trades per year is more than enough, sometimes not even, and I feel very comfortable about that, because keeping your stocks, like keeping your winners long term, will bring a lot more returns than anything else. That's what I saw over the past of my career. I've helped people going through 2008 crisis as a financial planner, and when you're holding the right assets for your risk tolerance and your plan, you just stay the course and it just do well. So yeah. The ETF, yes, Deb. So the two ETFs that we use, and this is our benchmark on XDV.to and VIG. Those are our benchmark as well, because the point is, if you can't beat dividend paying ETF, why would you spend so much time working on your portfolio, right? So our goal is to beat those. Usually those are dividend growers ETFs. They usually beat the market. So it comes around. That's pretty much the idea here. Yes, Veronique. Well, the good thing is I don't have any question anymore. 2 hours. That was great. Yeah, XDV and VIG. Yeah, I just put them in the comments, Deb. So that's are the two ETFs. Thank you so much for being there with me today. I've really had a lot of fun. So I hope that you have too. I hope that I gave you some more conviction to invest in your portfolio, that you're not going to wait until the next market crash. Because honestly, we never know what's going to happen, and the best timing to invest was always yesterday. The second best timing is today, and the worst timing ever is tomorrow. So stop being paralyzed by analysis and start investing. That would be my message today. If you have any question, I'm always around on Twitter, on my blog @BSR. Check out the offer. You're going to receive the replay probably tomorrow, because the 2 hours webinar is like huge, like over 1 gigabyte of data. So anyway, I had fun. Thank you so much for being there, and we'll talk to you soon. Cheers.